Two analysts can look at the same company and still be £5 billion apart in valuation, both using discounted cash flow, both using WACC, both completely confident, and both technically correct. So what's going on? Because WACC is supposed to be the anchor of valuation, the number that captures risk, the number that turns cash flow into value. It feels precise, it feels mathematical, it feels authoritative. But here is the uncomfortable truth. WACC is not observed, it is constructed. And once you put that number into a spreadsheet, something subtle happens. The spreadsheet stops asking questions, it starts giving you answers. Before we audit WACC, we need to be clear what it is trying to do. At its core, WACC answers one question. What return must this business earn to justify the capital invested in it? Not what it will earn, not what it should earn, what investors demand for bearing the risk. That is quite important. WACC is not a property of the company. It is a reflection of the market's expectations. The logic sounds reasonable. The business is funded by two groups, right? Debt holders who want fixed payments and equity holders who absorb uncertainty. Each demands a return. WACC blends those demands together. In theory, earn more than WACC and value is created. Earn less and value is destroyed. That is the promise. But notice what this assumes. It assumes we can measure those required returns. It assumes we know how risky equity really is. It assumes capital structures stay stable. It assumes markets price risk sensibly. These are some very strong assumptions, and WACC doesn't test them, it inherits them. The most fragile part of WACC is not the maths, in my view. It is the cost of equity. Debt has a price, right? You can see it in interest rates, you can see it in bond yields. Equity doesn't work like that. There is no contract, no promised return, no observable price of risk. So the cost of equity has to be estimated. Most models use CAPM, Capital Asset Pricing Model. Risk-free rate, equity risk premium, beta. The maths looks elegant, but every component is just an assumption. The risk-free rate assumes government bonds are stable anchors. The equity risk premium assumes history guides the future. Beta assumes past volatility explains future risk. These are just beliefs, not facts. And once they go into a spreadsheet, they start behaving like truths. 2 decimal places, clean outputs, precise valuations. But precision is not the same as accuracy. This is where false confidence creeps in my view. The cost of equity often carries more narrative than science, which is why two analysts can look at the same company and arrive at very different WACCs. WACC is not discovered, it is chosen. Then there is another illusion, capital structure. WACC quietly assumes the mix of debt and equity today will represent the future. But capital structure is dynamic, right? It changes with interest rates, credit conditions, confidence, management decisions. Yet, WACC freezes it in time. And this matters because debt is cheaper than equity. Most leverage lowers WACC. Lower WACC raises valuation. Higher valuation encourages more leverage, right? That feedback loop is rarely acknowledged. WACC quietly rewards leverage. Change the story and WACC changes. This is why professionals do not treat WACC as a single number. They treat it as a range, a base case, an upside case, a downside case. They don't ask what is the correct WACC. They ask what happens if this WACC is wrong, because this is where the real insight sits. A valuation that only works at one discount rate is not robust, it's brittle. WACC doesn't validate a valuation, it exposes its fragility. WACC doesn't give you certainty, it gives you a structured way to express belief, and belief requires judgment. In the next video, we will bring this together with price to earnings ratio, return on equity, and free cash flow, because each one feels scientific, and each one quietly relocates uncertainty somewhere else. If this way of thinking resonates, this channel is probably for you. Subscribe if you want to keep building that lens, and I'll see you in the next video. All the best.